In simple sort of basic idea pictures, right? Here's the way it works. Income comes in, and income is sometimes referred to as revenue, sometimes referred to as sales. What it's not is if you've borrowed money, the amount you've borrowed comes into your business, but that's not income or revenue or sales. Or if you've invested money into your business, that is not income or revenue or sales. That's a loan. So you can invest in the business, or you can lend the business money, or you can generate money through selling whatever products or services the business actually is meant to sell. That last thing, the thing that you sell, the income that you generate from actually operating the business, that's the only amount of money coming into the bank that goes on the profit and loss. And then you have expenses, which go out. Expenses are things you spend in the course of operating the business that come out of the sales that you're generating from the business. Or if the business isn't generating enough sales or any sales yet, then expenses are coming out of the business bank account that you funded from some other source. You put personal savings into the business, or you borrowed money in the business, or some combination, or you're putting it on credit cards that you will then pay from the business account, whatever it is. But not all the money leaving the bank account are expenses, only the ones that are used in the course of operating the business and that the accounting field says are expenses. So you've got income coming in from selling the product or service that your business sells, expenses going out from operating the business. And then if there's something left, that's your profit. That's the profit part of profit and loss. If it turns out the red portion is bigger here than the green portion, then you have no profit. And in fact, the difference is then a loss. If your expenses are 110 and your income is only 100, then you have a minus 10, a loss of 10, because your expenses were 10 greater than your income. If you have income of 100, expenses of 80, then your profit is the remainder, the 20 that's left. So this is just visualizing what is on the income statement. Income comes in, expenses go out, and is what's left. If it's positive, expenses are less than income, you've got a profit. If expenses are greater than income, you have a loss. Now, in a very basic sense, this is a P&L, a profit and loss statement, or an income statement. You have $10,000 of income that comes in from running the business. You spend $1,500 on advertising, $500 on office supplies, $1,000 on rent. If that was all you had for expenses, then you'd have a net profit of $7,000. $10,000 minus the sum of those three expenses leaves you with $7,000 net profit. So very basic P&L. All of them are built the same way. The income section is at the top, then the expenses section is in the middle, and then the net profit section is the last line at the bottom. And that's either a positive number or a negative number for whatever time period you're looking at.